You can choose to actually become wealthy. You have to take action for that. Pick the right operators.
Keep the investors in the loop. That goes a long way.
Keep that little bit of being scared and go forward with it, and like let that make it so you're not making dumb mistakes.
Hi guys, welcome. So today we are discussing, questions that an LP should be asking their GPs before investing, right? So as you know, we are general partners in the mobile home park space. So we meet with investors often. We get a lot of questions. Many times there's a trend in the questions, right? So with that, today is just what should LPs be asking? Whether you're investing directly, joining syndications, participating in funds, asking the right questions up front can help you better understand risk, opportunity, and alignment with the operators. So with that said, I'm here with my partners, Tim and Matthias. Say hi, guys. How are you guys doing?
Doing great.
Good.
Okay. So one of the main questions that comes up often is like, okay, cool. Like these guys are operating this deal. The deal looks really good, but how do they get paid, right? What are their fees? And this is something that comes up often. Tim, you wanna address that?
Yeah, it's a good question, and it's something that every LP should be asking any GP, right? So all of these topics right now, it's not just for asking us, it's for asking anything. If you're looking to invest as a limited partner in any deal, you should really be asking everything, doing your thorough due diligence. So on the fee side, what we generally do, a little bit different from deal to deal, but generally what we'll do, 3% acquisition fee, 3% asset management fee, 1% disposition fee. Those are like the big ones that I can think of. And of course, we do generally 70-30 split, 75-25 split, something like that. So there's some promote, meaning after we sell, after we get people their returns, we get paid. And then the important thing for us, we do. And if I'm ever investing in someone else's deal, I'm going to be looking for the same thing, which is if our investors aren't getting paid their preferred return payments, we're not getting paid. We have a deal right now that I wouldn't say it's gone sideways as much as it's just not as in this position that we would like it to be. But what we've done, we turned off our asset management fees to ensure that investors still get their preferred returns just like clockwork. I actually had one of the investors ask me about it. He's like, "What is this? Are you doing a Ponzi scheme? Because I'm always getting my preferred return." And we're laughing, and I was like, "No, the way that you're still getting it is that we're not getting paid. We're turning the asset around, and it's unfortunate, but it happens." And so, like, anytime someone says, "Oh, your fees are so much," it's like, well, that's a backstop for us. If need be, we can turn off that fee and not get paid so we can keep the asset, the strength of the asset, number one. We can keep the investor returns, number one. I had another guy who was kind of saying, "Hey, you guys get a whole ton in fees." And I said, "Yeah, it's amazing that we can take so much fees and still get our investors the returns that we're getting them. So far, more than projected." So that's one thing I'd say, maybe like, yeah, make sure that the fees aren't outrageous, but also make sure that your GPs are getting paid. Before we started raising capital, I've seen people who weren't getting paid and then just take off. And that's another thing. You don't want to shortcut your general partners so much that they don't care about the deal anymore. Anyway, that's me going off on a tangent now.
No, but I think it makes perfect sense. And I'm sure people watching want to learn from that, right? So something else that comes up often, or something that you should be asking your GPs, is how much of your own money is in the deal, right? Whenever we have a deal on the contract and we're raising funds and we close, how much of your own money goes into the deal? For the most part, typically it's 5 to 10% of the total price of the raise, showing that we have skin in the game. Also very important is WCG signs on the loan, right? It's important to know that the GPs are signing on the debt. Do you guys want to add to that?
Yeah, I love this because everyone thinks that, oh, they have $100,000 in the deal, they actually care, they're not going to walk away. And, I was reading The Hands-Off Investor, a Bigger Pockets book. A friend of mine who's a big LP in a lot of deals recommended it. And there is a part in the book where he's like, look, when you're vetting GPs, don't just ask them about how much money they have in the deal. And basically, that's not necessarily a skin in the game. It's easy to walk away from $100,000. It's a lot harder to walk away when you personally guarantee a loan on something. And if any of our deals go under, meaning, they go into foreclosure, people are coming after us. And, that doesn't just mean I'm losing $100,000. That means I'm losing millions of dollars over the course of what I'm projecting and planning, at least another 20 years of a career. And so, I do not take that lightly. And I'm not going to just, walk away for something that's going sideways. I'm going to get in there and make sure that it's righted so I can continue building this empire that I want to build with y'all.
Absolutely. Talk about skin in the game, right? Another question to ask the GPs: how much liquidity does the company have? Matthias.
Yeah, that's a good question. So when you look at our deals, it's been syndication so far. So when you talk about syndications, it's kind of a self-contained ecosystem, its own little entity, right? And then also same with the fund, it's going to be self-contained entity with its own liquidity. So what we always start with is about 3 months of debt service and operational expenses out right out of the gate. So we have something to lean on. We don't start with $0 and hope the collections come through month one to kind of keep the boat afloat, basically. So we have that in place, and we have capital reserves. We always accruing every month, or escrowing rather, into our construction accounts that actually, is rainy day money. If there's any surprises with the infrastructure or any budget overruns or anything else that could be a surprise, because there will be. It's not a matter of if, it's a matter of when. We have a liquidity on the side, so we try to maintain that 3-month buffer and actually grow it over time. And if it's getting a little bit too high, we can actually use that for distributions or invest it back into the property, etc. But the liquidity is always at a level that we can always weather some really good storms of, occupancy drops 10%. That can happen so fast sometimes, especially when you have a lot of park-owned homes, where you can just lean on some money and can actually use it for renovations and bring these homes back online and then feel a lot safer. So that's always what we do in our underwriting framework, to have at least 3 months of expenses of liquidity in each entity, in each fund.
Thank you for that. Something else that you should ask your GPs is, how do you communicate with your investors? How often? For us, we have monthly investor reports, and that's how we communicate with our investors. What should you expect in that investor report? Occupancy, right? Because every month things change. Financials, so it shows total monthly income and expense ratio, the NOI, account balances, reserves balances, CapEx balances. So something else that we show is the financial snapshot in a form of a visual in a plot, and how we compare it to previous months. Same thing with revenue and rent per occupied unit. Again, comparing that. Delinquency, right? That's important to communicate with the investors. Things change every month, so we want to be able to communicate that. In terms of general investor updates, distributions, that's a big question that comes up. Hey, what's the status on distributions? The monthly reports will have that, K1s, all that good stuff. So in summary, you want to be able to know the communication cadence that the GPs have, because the last thing you want is for you to invest your money and then everything goes silent. That's not a nice place to be. People work hard for their money. $50,000, $100,000, $200,000, it's a lot of money, right? So you want to be able to get plugged in and make sure that your GPs communicate often. For us, we make ourselves available. You have our cell phone numbers. We respond within 24 hours, 24 or 48 hours, and we are transparent. That's our motto. We try to be an open book. So, yes, very important to ask your GPs. How often do you communicate? What's your communication style? That way you want to know the answer before you invest and not after. Okay.
Vinny, real quick, I just want to say, I've talked to a lot of people who are invested in our deals, and I'm super proud of all the amazing work that you do, because it's always, hey, we love your communication. We love the investor reports. We they compare it to other people, and we always get great reviews from these people when I'm talking to them, and they're so thankful. So I love that, man. You're doing such a great job. I really appreciate you.
Thank you for that. And big shout out to Marianne. That's my wife. It's a team effort, right? You may see my face a lot on screen, but Marianne helps a lot on the background with the investor reports and helping out with the investor communication. It takes a village. So, but I appreciate that, Tim. Let's see here. Tim, on that note, let's switch gears here. A question to ask a GP. Have you ever lost investor money? Right? That's a good one. What do you answer?
That is a good one.
Yeah, it is a good one. How do you answer that, Tim?
So, but first I want to say, like, if someone says, yes, I have lost, like, I wouldn't say that's an automatic pass. It's an automatic, I'm not going to invest with them because they've lost money. Things go sideways. Things happen. Even the best people with the best intentions, like, things happen in real estate. If, I'd say the big thing is if they say, oh yeah, we lost this, it's like, how? Tell me the situation. What did you do? How did you react? Like that's a really big thing because we're in real estate. It's an investment. It's by its nature risky and speculative. And, we do everything we can to make it so low risk because we like to sleep at night, but nothing's 100% risk free. With that being said, for us, yeah, we've never lost any investor capital. We've always made our pref payments. Again, sometimes we've had to take less ourselves and we're okay with that. We understand the business. I've had times like before we raised capital, I had a deal that didn't go anywhere. And there was a possibility of one of the joint venture partners losing some money. We sold it for what we bought it for, but like this guy and a couple other guys bought it and then it was not operating well. And so my friend Ryan and I came in, we bought shares of other guys for $25,000 each, right? So our equity was a little bit more based on money put in. And it didn't go anywhere. It was my second deal and, we couldn't get it off the ground like we had anticipated. So we ended up selling for what they bought it for originally. And what could have happened, I could have said, well, here's my percentage of ownership, so I'm going to make a little bit of money. But the other joint venture partner was set to lose a decent amount of money. So what we said was, hey, let's all just call it, let's all get our money back, our original capital back. Let's get it back and everyone can be made whole. And, that to me is worth a lot more than making a little bit of money or a lot of bit of money. If we're being honest, like I was saying earlier, I have a big, at least the next 20 years time frame on things. So even if it was sacrificing a lot of money, it's still worth it more to me to make people whole and do the right thing so that we can all continue to the next deal and we can, leave things all good or as good as they can be.
Absolutely. Thanks, Tim. As you know, investing is risky, right? So that's why we're having this webinar so you can be equipped with the right tools, the right questions to ask your GP. It may not be us, right? But, if you want to invest, make sure you ask a lot of questions. You do your due diligence. So again, right, it's risky. So you see a lot of people raising funds because they want to close an asset. It could be multifamily, it could be storage, it could be anything. The question that you need to ask is, who actually runs the asset after closing? Matthias.
Oh yeah, we have a good framework for this, a pretty good structure in place for that. So we have our own property management company. So everything is in-house managed, which is our back office, we call it. And the back office is really having a thing on the pulse with the community managers on site as well. So there's like, 2 layers right there. And above that, there's an asset manager. That person is mainly just focusing on where are we in the business plan. We need to bring 4 homes in this year. Where are we with this? How do the KPIs look? Occupancy, collections rates, and even from there we look in a lot deeper as well on the KPIs of like leasing rates and like application to lease conversions and even like lead to application conversions and see what market behaves in what way. And we can kind of also use that as kind of like data if you want to keep buying in that market. If we see leasing is difficult in that market, we say, okay, how aggressive can we be in our underwriting in the future? So we use all that data to be very successful for like also our acquisitions. So it's not just like this one bubble in our organization like that runs that asset, but also it feeds data to other departments, so to speak, to acquisitions as well, to give feedback on like, hey, this market is tough for leasing, but this market over here, we can lease up stuff within like days, really quickly. That means we can also be more aggressive in the underwriting and stuff like that as well. So on the management side, for on the ground for like renovation management and stuff like that, it's mainly the asset manager making sure things get done on time and the community managers executing the plan on the ground. Whereas the back office is mainly looking at KPIs, getting the paperwork done, the leasing done, creating accounts for people in the system or helping them getting them into the system, give people a hand of like how to navigate through the system. And we have elderly residents as well that might need some help with technology, so we have our back office helping there. They have some human touch. And we also have a lot of AI features we implemented recently for like the mundane work. For example, for collections, for example, where collections calls are made by AI agents, and you cannot really tell the AI. They're really well, engineered and developed AI bots that we're using with a company that we partner with. So that works in an excellent way right now, and that is also managed by the back office, and they can know exactly if somebody picks up the phone on the collection side and they promise to pay and they want to do a payment plan to get back on track. We get a report once a day, and our back office then takes it from there and has a very targeted approach on collections. Instead of talking to 100 people a day, they just talk to 5 where the AI already sniffed out where it's worth having the conversation in the first place. So this is the overall structure how we manage this, and there's a lot more we can go into. It's a lot more granular, but this is the overall 3-layer management layers that we have for our assets, and I think that's where we stand out really, really well. It's not like we're the first ones that have been doing it. We're just very disciplined while we do it, and we do it over and over again. And rolling it out to a new asset, it's just like, same thing, same process for a different asset. We're just rolling it out, and it's going to be the same process over and over again. And it's just rinse and repeat from there. Of course, with different challenges for different assets in different areas, but overall, it's like 98% the same thing over and over again, and the same decision making based on the data we're receiving.
Yeah. So this may not be a question that LPs ask GPs, right? But a lot of people may not want to invest as limited partners in deals because they see a lot of operators struggling right now. Maybe some deals are going sideways. So right now they may be fearful. Tim, what would you say to these people that have fear of investing as an LP at the moment?
Good. Be fearful. Like you should. So, I'm a retired nurse, and I remember talking to new nurses, and they're like, oh, I'm scared. I'm like, good. Keep that little bit of being scared and go forward with it, and like let that make it so you're not making dumb mistakes. Let that enhance your diligence of someone or some group or whatever. Like a little bit of fear is okay. What I'd also say is, so what I'm afraid of right now is not doing something with my capital and just keeping it, on the sidelines, because I see the trends, I see the likelihood of the continued devaluation of the dollar. I see things, the dollar going not as far as it has. And not just this year, not just last year, but over the past, 20 years. You look at the strength of the dollar versus like gold versus other things, and it's like, it's creeping down. And so that worries me, not doing something, having a job and then just getting your 2% raise once a year if you're lucky, and just slowly watching the world around you get more and more expensive, and you being able to afford less and less. So that's what scares me. So it's like, okay, how can we hedge against that? How can we put money into something that holds value long term and cash flows? And obviously, mobile home parks, that's the way to do affordable housing, super recession resistant. I'd say for those, acknowledge your fear and acknowledge that it's okay, and also think about the bigger picture. And we were talking before, Brandon Turner's in the news and he lost $15 million of investor capital, and I'm so afraid. And then you get other people saying, oh yeah, don't, like, syndicators, capital raisers, fund managers, they're the devil. What you should do instead is this. And it's like, okay, well, first of all, the people who are saying that are the ones who are probably selling some kind of course or some kind of like way to do different kinds of real estate. So always follow the money, like whatever. Sure, like some different ways. Nothing's foolproof. Nothing is 100%. So like, yeah, you can go and make a lot of money with sub two or something, but then it's like, well, what about the guy who just lost millions of dollars of sub two stuff in Florida and, it has left all these homeowners high and dry? Sure, sometimes there's bad actors like this guy, and I'm very confident that Brandon Turner's not a bad actor. Like, he didn't go in wanting to do that. He just got caught in a black swan situation where they bought a great asset, they put great debt on it, maybe too short, but who would have known back then? He's not the only one. He's just the largest, most public figure to do that. I mean, what I will say is, you guys know I had that small group thing with Brandon up in Tahoe last year. And first of all, super nice guy, super nice guy. But what really stuck out to me, we were all hanging out, and he had to leave. Like, it was, after dinner hangout, and he had to leave early. And he said, "Hey, I got to get on an investor call." And he said, "I got to tell everyone why they're not getting distributions this quarter." And that sucks. That totally sucks. But you could see how like heartbreaking it was for him. Like, so again, I'm confident he's a genuine guy. I think they got caught up in something super unfortunate. I don't think they're the only guys that got caught up in it. So it's like everyone's saying, "Oh, look what happened to Brandon. He's so well known. If it can happen to him, it can happen to anyone." And it can happen to anyone, but it was a very weird time. If anyone was in the game, the real estate game back then, it was frothy. Capital was cheap. Everyone was looking to put money into deals. Everything like was trading for super expensive costs. I put a ton of offers out back then, but I was too new and I couldn't even like compete, not even close to what people were buying. If I could have, I would have, and I would, I'd be in that same kind of or similar boat where, oh shoot, I've lost all this and whatnot. And so it's not that I'm smarter, because no one was smarter back then. Like, it was a surprise to everyone when rates really started going up like crazy, because the inflation was crazy and all that stuff. So yeah, man. I mean, I know I'm ranting. I know I do that a lot, but I'm thinking it could have happened to me. It didn't, but it could have. But like, I do know from just a personality perspective, we are the types of people that if things go sideways, and they do sometimes, we figure that shit out. We don't just let it say, "Oh, sorry, it went sideways." And I'm not talking crap on Brandon right now. Like, I've read it, I get it. It happened. There's no other way that it could have happened. But I know for us that if anything crazy happens in the market, we figure that shit out.
So to add to that, I think the important part when things go sideways is to make sure you communicate with the investors, right? I think that goes a long way, because something happens, why did it happen, and what are we doing to make it right? That in itself goes a long way. The last thing you want to do is work with somebody that stuff is going sideways and they're not communicating. And even worse, maybe they're communicating that everything's still good, and that's not the case. So yeah, I think make sure you vet your operators, make sure you get a good sense of who they are as people, right? People with integrity, morals, Again, stuff happens, right? But when things go sideways, are they going to show face and say, "Hey guys, this is what's going on, but this is what we're doing to make it right"? Keep the investors in the loop. That goes a long way. Another thing that you made me think about is, yeah, things are getting expensive, right? Gas prices are super high. Wouldn't it be nice to have extra money now, like now, right? So another question to ask your GPs is, hey, when do I start getting paid? You're going to get my money now, but when do I start getting paid? Does the business plan state that you get paid after the units are rehabbed? When is that, like a year or 6 months? When do I get my first distribution? We incorporated a change recently, right, within the last 6 months. I think we did it with our last deal at the end of last year when we closed. We moved from quarterly distributions to monthly distributions. So after 3 months of closing on a deal, you will start getting monthly payments, monthly distributions on your investment. And how are we able to do that? Finding good deals that cash flow day one. So again, ask the right questions to your potential GPs. All right, this was a really good session. I think we just want to add value. If you don't invest with us, that's fine. But we just want to educate you, right? We want to give you the right tools, the right questions to ask your operators. Guys, any last minute comments?
Do your research. I think don't trust everything you see, what you see on the title and what people are trying to sell. There's always something attached to it. Be fearful, like Tim said, that's good because it keeps you on your toes. Use that fear though and still be courageous and to build a future that you want. You can choose to be secure and comfortable. You can choose to actually become wealthy. You have to take action for that. Pick the right operators. There's people out there that lost people's money, but people like Brandon and others, I would almost trust them more than some other people because they actually show up when things get tough and they don't want to do this again. They don't want to feel this pain again. And I think if they would actually keep doing that business, which I hope they do, I think they will be stronger than ever. I think that shows a lot of strength as well. And he got caught up in a really bad cycle, which many people got involved in as well because things, were changing in an unprecedented level. So yeah, don't get discouraged by that. There's always bad actors in every industry, in every type of business out there. Obviously, Brandon is not one of them. We can actually learn from what happened to Brandon and other people as well, and that's what we are doing. We're looking at the issues that happen with people and see how can we prevent that from happening to us. If rates would double from here, could they? We would probably say probably not because they're pretty high already, but I think nobody thought in 2022 they're going to double in 2022. So we stress testing deals accordingly on our end to see will this actually survive at a 12% rate if it's 6.5 right now. And our recent deal does it, because they cash flow really well. Because we learn from other people's mistakes and their pain. So do your research, place your money wisely, and of course, if there's any questions with WCG, we're here for you. Just shoot over a question and one of us will answer it.
Tim?
Make sure that no one is taking on short-term debt. So it's funny, I frequently am talking to Matthias and I'm like, how do we make the debt longer? Everything's a 5-year timeline, but how do we do 10 years? And we're talking with Judah from Princeton and Chaim from Meridian and everyone. It's like, hey, we need to get longer term debt because the thing with the Brandon deal, is if his debt was a couple of years longer, it might have turned it around. Like it came due and cap rates were crazy, went crazy high, and then the value wasn't there, and so they had to put in either do a cash in refi and to get that loan going. But if he had a couple more years, maybe it wouldn't happen. If he had 7 more years, it definitely wouldn't have happened. Or not definitely, not 100%, because come on, but more than likely, man. You can right a ship in that amount of time. And so yeah, make sure that you're not investing in something that they have a 2-year loan on it, and the same guys who get 2-year loans say, okay, I can infill with 100 homes in 2 years, and I can make sure that this goes from 2% occupancy to 90% occupancy in those 2 years, and it's too much. It's too much. Make sure that your operators are have a reasonable plan, that it's not they don't have to stand on their head to make sure that the business plan works out well. We do little levers that we pull to make the business plan work.
That's actually a huge nugget you just gave right before we closed, because you want to make sure you look at the debt. Sometimes you can have a really good deal. You can have decent or pretty good operators. If they have bad debt, that's a huge risk, right? So make sure you look at that before you invest your money. Thanks, Tim. That was a really good nugget. So yeah, with that, we want to thank you guys for joining us. I know everybody's busy, so you're taking the time to listen to us and learn a thing or two. We hope this discussion gave you a better understanding of the questions LPs should be asking before investing their hard-earned money with GPs. As always, do your due diligence, ask questions, and invest with partners you trust, right? That's why you're doing the legwork. You're talking to people. If you'd like to learn more about WCG Investments or our current opportunities, we'll love to hear from you. You'll find our contact information below. Feel free to reach out. We're here to help. And again, you don't have to invest with us. If you want to reach out to ask questions, we're here for you. Thank you for your time, and we look forward to connecting with you again soon. Have a good weekend. Take care. Bye.
Thank you.
Bye.